Good morning and welcome to the TRITAX EUROBOX PLC half-year results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all the questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Phil Redding, CEO. Good morning to you, sir.
Thank you, Alexandra, and good morning, everyone. First, thank you very much for you all joining us this morning. My name is Phil Redding. I'm the CEO of TRITAX EUROBOX. And this morning, we're going to run through our results, the lineup today of what we're going to talk about. Hopefully, we're going to move on to the next slide. And I'll talk through that. So you're going to first hear some key messages and a brief operating overview from me. I'll then hand over to Mehdi Barassi, the company's CFO. I'll come back then to provide a bit more colour on the market and the outlook for the business. And then we'll open up for some questions. But moving to the first slide to open up. So over the last 6 months, we've continued to make good progress with the strategic priorities we outlined 18 months ago. And we also have good visibility on the delivery of further initiatives in the second half of the year. 4 key messages that I'd like to start off with. Firstly, we have a very high quality portfolio that remains well positioned to benefit from the favourable market dynamics and positive structural drivers that continue to underpin the European logistics sector. But reflecting the subdued investment market conditions, the value of our portfolio has declined marginally over the last 6 months, although we are now seeing signs of investor sentiment improving. We delivered a solid operational performance and further progress with our priorities, particularly advancing the disposal programme whilst maintaining a covered dividend. And looking forward, we have good visibility on delivering our objectives over the second half of the year, in particular to complete the disposal programme, reduce our LTV to the low 40s, keep the cost ratio within our target range, and maintain a covered dividend. So first, a quick review of our operational performance. When I became CEO of EUROBOX back in the end of 2022, I outlined 4 key priorities. These were to grow income, to manage costs, drive earnings to support a fully covered dividend, and maintain balance sheet strength. And we've made good progress on all of these over the last 6 months. In particular, the disposal programme that has had the effect of lowering the leverage in the business, but as expected, this has impacted some of our financial metrics, and reflecting these sales, annualized rental income has declined 2.6% to 74.3 million euros. The cost ratio, however, is at 24.1%, improved slightly, and remains within our stated target range of 20 to 25%. Adjusted EPS declined 3% to 2.62 cents, again mainly due to disposals, but with the dividend of 2.5 cents remaining fully covered at 105%. And including the recent sale of Gothenburg, we just announced last week, the disposal proceeds now total 173 million euros, with the pro forma LTV reducing to 43.3%. Based on this performance and the quality of the portfolio, Fitch reaffirmed our investment grade credit rating and also upgraded their outlook to stable. And with that, I will now hand over to Mehdi for the financial review.
Thank you, Phil. Good morning, everyone. Let's start with the headline figures and let's go straight into it. Basically, our IFRS rental income increased 10.1% to 35.9 million against H1 last year. This was mainly the result of rental guarantees on development, which have converted into leases with customers, which are now recognized under IFRS as income. Our costs have evolved favorably as well. As Phil just mentioned, the investment management fee cuts delivered in the prior year, combined with the lower NAV, means we have an adjusted cost ratio of 24.1% for the period, which is down from 25.6% in H1 last year. The adjusted EPS has come down 3% to 2.62 cents from 2.7 cents in H1 23, and this is mainly the result of the different disposals we've done over the last 12 months. But despite all these disposals, I'd like to flag that dividend remains well covered. On the balance sheet side on the right, you can see that we had another set of yield expansion on the property yields, which led to a 2.9% like-for-like drop in our valuations. But on the flip side, ERV growth was strong at 4%, and this helped to mitigate some of the impact of the yield expansion. So if we move to the P&L and go into more details on the figures, and let's start with the income. All the figures you see on screen are annualized. And if we start on the left and move to the right, we started the year at 76.3 million. We had indexation increasing the income by 0.6 million. We had also new asset management initiatives and lettings, which delivered 1.2 million additional income. However, we also had a unit become vacant during the period in our Bremen assets, and the rental guarantee at Rosersberg 1, which expired, which meant a loss of 2 million combined, which you can see there on the screen. This was partly compensated by the completion of the fully let Polish extension in Stryków, which delivered 0.5 million additional income. And finally, the disposals during the year meant we lost 2.3 million additional annualized income in the period, which led to a total at the end of the period of 74.3 million annualized income. If we look on the like-for-like basis, the annualized income has decreased 0.3% during the 6 months. If we exclude Rosersberg, which is the only non-stabilized asset in the portfolio, it has actually increased by 0.6% for the 6 months. And as usual, our indexation within the portfolio are weighted to the second half of our financial year, and hence we are guiding to a like-for-like rental growth on the stabilized portfolio, so excluding Rosersberg, of 3 to 5% for the full financial year. So moving to the cost side and to the earnings, as mentioned before, the EPRA cost ratio has continued to improve. We expect the cost ratio to remain within the set target of 20 to 25% for the full financial year. As I said earlier, the disposal program has reduced income, and therefore the adjusted earnings have come down slightly from 2.7 cents in H1 23 to 2.62 cents at the end of this period. And we have announced yesterday a steady dividend of 1.25 cents, which means the company remains well covered at 105%. And if we look forward to the full financial year, we expect the dividend to continue to be covered despite any new additional disposals we might do as part of the disposal program we announced 12 months ago. So now if we move on to the balance sheet, let's start with the valuations first and move to debt after that. So as I mentioned previously, the valuations have continued to drift in the first 6 months of the year. This was the result of new transaction evidence, which reflects the ongoing higher rate environment. As you can see on the first chart on the left, the net equivalent yield has expanded by 26 pips for the 6 months. If you now combine this with the 102 bips you see during last year and the 31 bips in H2 2022, the net equivalent yield has expanded by a significant 159 bips since the peak, which is a 44% increase in the property yield over the 24 months period. Now, if we come back to the last 6 months, it means the portfolio has dropped 2.9% on a like-for-like basis. That's on the middle chart. If we combine that with the impact of the disposals in the period, the portfolio valuation is now 1.47 billion, against 1.56 billion at the end of September 2023. Now, on the flip side, and getting to the right-hand side of the slide on the right chart, the yield expansion has continued to be partly offset by strong market rental growth. You can see that the market rental growth has increased by 4% over the last 6 months, leading to a total reversion potential, which is the difference between market rent and passing rent in the portfolio, of 21.3% or 15.9 million in total. Now, if we move on to the debt side of the balance sheet, you can see we continue to maintain a strong position. We have a total available debt of 950 million, of which 250 million is currently undrawn. The earliest maturity is the revolving credit facility, which is undrawn, as I just mentioned, and which matures in October 2025. And beyond that, the green bond matures in summer 2026. On the green bond, inevitably, we expect the refinancing rate to be higher than our current cost of debt. We have a little over 2 years until that bond matures, but we are already working on a plan to refinance that. 100% of the debt which is drawn is fixed, and the cost of debt during the period was 1.43%, a slight increase against last year. We expect, on a look-forward basis for the full financial year, for the debt to remain within a range of 1.25 to 1.5% for the full financial year. And finally, a good news, our credit agency Fitch has not only reaffirmed our investment grade rating earlier this year, but also upgraded our outlook from negative to stable. This is mainly the result of the successful disposal program in the last 12 months, where we sold 139 million euros broadly at book value, and this improved the visibility on a number of our key debt metrics, including the net debt to EBITDA and the LTV. So if we dig a little bit more deeper on the LTV, it has continued to fall. As a reminder, we announced 12 months ago a revised LTV target in the low 40s. It was previously 45% as a target. We have now low 40s. And if you move left to right on the slide, you can see that we started the period in September 23 with an LTV of 46.4%. The combined disposals of our Bochum asset in Germany and Malmö in Sweden meant the ratio dropped by 2.7% because of these disposals. We had also favorable working capital movements during the period, which we talked about in the last presentation in September 23. This has lowered the LTV by a further 1.1%. Now, on the flip side, we are also progressing on some of our development pipeline with some capex spent during the period. This has increased the LTV by 0.2%. And finally, you can see the impact of the valuation movement, resulting in a year-end or in a period-end LTV of 44.5%. Now, immediately post-period end, actually at the start of this week, we announced the disposal of a further asset in Sweden, in Gothenburg, which was again broadly in line with book value, and that will decrease the LTV on a pro forma basis to 43.3%. And I'd like to flag that our objective remains to keep the LTV in the low 40%, with the aim to complete the disposal program by the end of the calendar year in 2024. So to summarize very briefly before I pass over back to Phil, operationally it has been a good 6 months. The key priority was to manage the balance sheet. I'm pleased Fitch not only retained the investment grade rating, but also improved the outlook to stable. This was achieved thanks to the disposal program at around NAV in a market which is quite difficult with very low volume because of the macro uncertainties. We expect to complete the announced disposal program by the end of this calendar year. And while the disposals have inevitably reduced our annualized rental income, The dividend remains well covered, and we remain confident we'll continue to deliver a fully covered dividend in the second half of this year. Back to you, Phil.
Thank you, Mehdi. Excuse me. Now look at a quick overview of the market. And looking at this chart, starting with the left-hand side in the investment market, the top chart there showing with the outlook for interest rates turning a little bit more positive, investment volumes have increased 17% over the last 2 quarters from the same period 12 months ago. And then moving to the bottom left chart, which shows the extent and change in pace of price adjustments across our markets. The green bars here showing the change in yields, which you can see have slowed markedly compared to this time last year. And the 26 bips change there is exactly the same, or exactly in line, I should say, with the Eurobox portfolio movement. And on that chart along the top, it shows where yields currently stand, and at these rebased levels, these are being seen increasingly by investors are attractive entry points, particularly when compared to the rental growth being generated by the strong underlying fundamentals. And turning to the right-hand side in the occupational markets, again, the top chart shows, as you can see, take up continuing to slow. Part of this is a normalization from recent really exceptional levels of take up, but we are seeing signs that the weak economic outlook is beginning to lead to some caution from some occupiers and decision making taking a little bit longer. Going to the bottom right chart, the vacancy continues to edge up but remains at relatively low levels compared to previous market levels, and also hides some significant differences between countries and also at local market level, with the availability in core markets, particularly where the Eurobox portfolio is concentrated, remaining limited. So based on these demand and supply dynamics, rental growth continues to be generated, albeit below the very high levels we've seen in recent years, but still healthy by longer term standards. So bringing all this together, the higher interest rate environment has translated into a bit of weakness in investment markets and a degree of caution in occupational markets. There's a growing consensus that the interest rate driven yield shift is now behind us, and the backdrop for logistics markets should turn more supportive over the second half of the year and into 2025. Just a quick look at our portfolio and its characteristics. This is a key strength for the company, which allows us to benefit both from the sector's positive growth drivers, whilst also providing defensive qualities in tougher market conditions. And along the top there, you can see that we operate in well-established Western European logistics markets, with a portfolio made up of modern, predominantly large-scale buildings with excellent ESG credentials. And then along the bottom, the strong income characteristics shown by our strong customer base, long-term leases, the indexation structure, with over 80% of our leases subject to annual inflation-linked uplifts. Now, these attributes combine to generate a robust and predictable source of income, and this is reflected in the 100% rent collection and achieved since the inception of the company, and high occupancy rate of around 96%. And looking ahead, the portfolio remains well positioned to grow income, both through the regular uplifts from the inflation-linked leases, but also our proactive approach to capturing new income, which I'll come on to now. So in terms of asset management and development, it's been another very busy period of portfolio activity. And looking at the asset management first, I'm not going to go through all of these individually. The slide here provides an overview of what we've been up to, but our activities include initiatives across a wide range of activities and countries, letting activity on new speculative schemes, as well as re-gears and customer expansions on existing space, with rents agreed at or above market levels. The result of all that activity has been to reduce the portfolio vacancy from 3.9% to 3.1%. And although it's been a really active year, there's plenty more for us to do. And the bottom table there shows the leasing priorities for us, particularly at Rosersberg, which will be our focus in the second half. On the right-hand side shows our development activities, and after a very busy period in the last financial year, we now only have one project to complete at Oberhausen near Düsseldorf. The 23,000 square metre brownfield development is currently on time and on budget for completion in Q3 2024, with potential of income of 1.9 million euros when built and let. And this will also be a key priority for the team in the second half. And finally, in terms of extensions, we've got two building extension opportunities on land we currently own at Geiselwind and Wunstorf. Taking a quick look at our solar PV performance, which remains key in terms of improving the portfolio's ESG performance. So working with our customers over the last 6 months or so, we now have 4 new solar projects ongoing at our assets in Germany. And you can see these in the middle of this slide with some of our existing schemes there on the left. We made good progress during the period. We've secured a guaranteed long-term floor price for all the power entering the grid on those 4 schemes. And we'll look to secure agreements with our customers and start installations hopefully towards the end of the year. And as you can see on the right-hand box there, these new projects build on the increased capacity we delivered in the last financial year and will more than double the installed capacity to 21.5 megawatts. In the near term, we've got a further 6 megawatts of capacity which can be installed across 3 more assets in Germany, plus an extension of an existing scheme in Italy. Looking now at our disposals, we launched this program about 12 months ago, and it had 2 principal aims: to improve our balance sheet metrics, particularly our LTV ratio, but also to fund existing opportunities within the portfolio, subject to these delivering acceptable returns. And so the Bochum assets, which we sold, this is mainly due to having limited opportunity to add further value following the completion of the asset management plan there. Malmo was sold for a data center use at a price nearly 40% above book value. And very recently, we've also sold the asset at Gothenburg for 34 million euros, 3.8% below the September 2023 valuation. So to date, the gross proceeds from all this activity has generated 173 million euros, with the combined exit price in line with the aggregate book values. So I'm really pleased with the progress we made on the disposals and the impact that's had on the LTV, and we anticipate completing the planned disposal program by the end of 2024 in line with the previously announced timescale. Now, this chart shows the future income growth potential of the portfolio. The first 3 buckets there show the embedded income opportunities, which are made up of indexation, estimated at 4.8 million euros over the next 3 years, lettings and uplifts above rental guarantees on unlet space, adding 1.7 million euros, and portfolio reversion of 12.3 million euros on let space. The next bucket relates to projects with committed capex. First, the Oberhausen development, which I mentioned, which is expected to add 1.9 million euros when finished and let. Then the 4 solar schemes in Germany, again, which I just mentioned, which are anticipated to generate 0.9 million euros when all fully installed. And the last bucket includes projects where capex has not yet been committed, the 2 extensions at Geiselwind and Wunstorf, and these could add up to 2.5 million euros in the near term. So we continue to have good visibility on rental income growth, which underpins our confidence in delivering our strategic priorities in the second half. So to conclude now, the higher interest rate environment continues to frame investor behaviour, but with a growing consensus that the rate hiking cycle is now behind us, this should lead to a more supportive backdrop for asset values for the remainder of the year and into 2025. Our portfolio of high-quality assets with strong income characteristics continues to be well placed to benefit from the sector's positive growth drivers, with its defensive qualities also providing income security through the cycle. And although market conditions have been challenging over the last 6 months, we've made good progress in delivering our strategic priorities, which you can see on this chart. We've worked hard to capture new income from within the existing portfolio, and we expect like-for-like rental growth to move up to between 3 and 5% on the stabilised portfolio in the second half. We continue to manage our cost base and expect to maintain the cost ratio within our target range of 20 to 25%. The dividend has now been covered for 7 consecutive quarters, and we expect it to remain fully covered for the financial year 2024, including the impact of the planned sales. And we are on course to complete the disposal programme by the end of the year as originally outlined, and expect the LTV ratio to move to our target of low 40s to maintain our balance sheet strength. And just to close, a reminder of the key messages. Our high quality portfolio remains well positioned. We've delivered a solid operational performance, made progress on our strategic priorities set out 18 months ago, and have good visibility on driving performance in the second half. So that concludes our presentation, and we'll now be happy to answer any questions. I'll hand over to Charles to moderate that.
Thanks, Phil. Yeah. Do submit your questions into the webcast viewer. We had a couple submitted ahead of the presentation, which I'll tackle first. I'll probably come to you, Phil, for the first one, and then Mehdi on the second. And while we're doing that, yeah, do feel free to enter your questions. So I'll read them out, and then I'll pass them over to be answered. So on the first one here, so how do we feel about the latest NAV, and do we think we've reached a point where further devaluations should be limited? So Phil, any comments there?
Yeah, so well, clearly over the last sort of 18 months or so, the valuation has declined quite significantly in line with the market. Actually, at the end of September of last year, that 6-month period, the valuation declined 0.3%, and as I mentioned in the presentation, over the last 6 months, it's declined again like for like 2.9%. I think at the end of last year, there was an expectation that interest rates, well, the Fed and in Europe, would fall quite considerably. That didn't materialize. So over the last 6 months, that has led to investment activity remaining pretty subdued. And I think that has led to the drift outwards in valuations again. I mean, looking forward now where we are, I mean, as I outlined, I think that the backdrop with more visibility on where interest rates could go and greater activity coming through in the investment market, I think that's a much more supportive backdrop for values going towards through 2024 and into 2025. So in terms of values, whether or not, I mean, I think they're there or thereabouts in terms of where valuations should be. I mean, saying that, there may be specific asset factors or sub-market factors that lead to some very modest further outward movement, but broadly there or thereabouts, I would say.
Thank you. Okay, and the second question here, Mehdi, this is for you. Do you have any comments on the dividend profile since IPO, sort of the growth rates and how it's been more recently? I guess you mentioned cover in your presentation. How would you any further comments or color on that?
Sure. Let me start by saying that dividend is very important for us, and it is very important for us to be fully covered. And very pleased we have been covered in the last 7 quarters. If we look back at IPO, I'd say we are in a very different macro environment today, and we acknowledge that, especially on rates, which have moved up quite a bit since IPO. So if we look at our dividend today, the 5 cents, and looking forward, I'd say you have 2 sides to it. You have the income side, and on the income side, we have great visibility. Most of our rents have annual indexation. We will capture a number of asset management initiatives. We have one development outstanding which will deliver additional income. So from the income side, it's looking very positive, and we should expect it to grow. Now on the cost side, and more specifically on the financing cost side, we have that green bond of 500 million euros, which matures in summer 2026. And inevitably, that green bond is going to be more expensive than our current average cost of debt of 1.4%. Sorry, we're laughing. So that means if we are looking forward, the dividend of 5 cents, we would like to protect it as much as we can, and we have guided to fully covered dividend for this financial year, and we have good visibility for next financial year as well. But it would be unreasonable for us at this stage to grow the dividend given the uncertainty on the refinancing rate on that green bond.
Thank you. Okay, one here. Can you please really provide some examples of initiatives taken to capture income growth within the existing portfolio and the impact on their financial performance? I feel that we spoke a little bit about the asset management slide, so
maybe go back to that slide.
We could tackle that.
So I think there's, if we just go back to the portfolio characteristics slide, so if you just,
okay,
I wanted to start with this, because I mean, first thing about the inherent opportunities to capture income growth, on the bottom right here, it shows the structure of the portfolio that we have. So long leases, but importantly, the vast majority of the leases are either index linked or exposure to some sort of CPI indexation. Or fixed, and the vast majority is subject to annual uplift. So structurally, there is the ability, obviously, for the portfolio to move forward. But that's inflation. That's not us. In terms of what we can do, I mean, obviously, it's important to, for the portfolio to have that structure. But as well as that indexation, we've got to work at asset management, development, leasing activities to move income forward as well. So if we just go down a couple now to the slide that demonstrated some of this, I'll maybe go into a little bit more detail here. So, I mean, some of the recent activities in the portfolio that we've been doing. Rosersberg is a speculative development that we funded. Recently leased our first unit there. When we acquired that, we made assumptions about the level that we would lease that out. When we actually came around to leasing that, it was 20% above that underwrite level and also above the market level of rents our valuers were putting on it. Strykoff, we've had a couple of successes at Strykoff. There's two on the chart here. One is with an existing company that was growing, so we facilitated their expansion at the same time as leasing that new area to them. We've also re-geared the entire space on a new lease. So that drives income, but with the new lease, it also drives value as well. Again, at Settimo Torinese, I mean, Northern Italy's been very active. Again, a scheme that we funded, a development that we funded speculatively, so no tenants. There were rental guarantees in place, but we leased these units within that period, again, above the market level of ERV. And at Strykoff, it is quite interesting. This is only a short-term lease, so it's only 10 months. But Avata are a very important customer to us. They do a lot of contracts for H&M, and the ability to move quickly and help them out for that 10-month lease. Hopefully, that will turn into a more formal arrangement. And then at Bornham, again, another interesting example of how we can protect income, if you like. One of the units there, a tenant was going to move out, so potentially creating a void for us. But our existing customer there, who we knew wanted more space, we've managed to lease that space, take a surrender from the company that was going to leave, release the space to our existing customer, re-gear all the leases, again, creating more value. But there's more for us to do. So again, there's the leasing there at the bottom at Rosersberg 1 and 2, which is a key priority for the team, and that's the majority of the vacancy. So our new building that we will be finishing in Oberhausen in the summer, again, a great opportunity for us to increase income there. So hopefully that provides a little bit of an overview of what we're doing to push those rents forward.
Yeah, thank you. And then Mehdi, I'll come to you on this next question, and maybe we'll we can bring this slide on LTV back onto the screen. So who else? So when looking at disposals to reduce the LTV, given recent valuation declines, what are the strategies around that, and how do we navigate volatility? Do you have some comments on that?
Yeah. So as I said, the target LTV is in the low 40%, and it's a target which we have set ourselves. I'd like to remind everyone that the loan covenants, we are very far off these loan covenant thresholds. For example, on the LTV, the threshold is at 65%. We feel at this stage of the cycle and at this stage of the life cycle of the company, an LTV in the low 40% is appropriate. In terms of managing the total debt quantum, it has actually come down a bit in the last year, mainly due to the disposal program. The revolving credit facility, as I mentioned earlier, is now fully undrawn. And as I said, as we just announced earlier this week, we've done an additional disposal in Gothenburg, and we are likely to do an additional disposal in the second half of this financial year. So we'll create a little bit of an excess cash, which will not be used to repay the RCF because it's fully undrawn, but we are likely to use that additional cash to help on the refinancing of the bond in 2026 to reduce simply the quantum. Instead of refinancing 500 million, we will be refinancing a smaller nominal amount.
Thank you. Okay. And one here on the board strategy. It's quite a long question, so I think I'll look to summarize it. And it's about shareholders have taken pain over the company's lifetime. And so what is the board considering, or how does the board think about that? And then the NAV being different from what was set out at the IPO. So one of the comments here, and it references the winding up of the fund within those board options. So Phil,
I think I get the drift of the question, and let me be clear on this. So, and I think first, fundamentally, the board and the manager are very aligned in terms of what the company should be doing and considering. I think whilst there is alignment that we think the strategy is right, we're delivering on the strategic priorities, and the opportunity indeed in the logistics sector in Europe is still very exciting. We have to acknowledge that the shares continue to trade at a persistent and significant discount, and we need to address that. And so the board and the manager are aligned in exploring all avenues to enable that to happen. It will be a wide-ranging review, and nothing is off the table.
Okay, that's very helpful. And then one here on EPS. So despite the decrease in EPS, dividend cover remains strong. So maybe would you expand it? You've made a couple of comments on this, but anything further to add on that?
Not really. It's all about trying to control what we can control and work on that and improve the income. The financing cost in 26, as I said, is uncertain. It's very volatile at the moment. It's not something we can control. So we focus on what we can control, which is properties driving the income up, trying to regear leases, trying to drive the rents up, and we expect that to help protect the dividend cover.
Okay, yeah. Very helpful. I think that I know we've got one more question that's come through. So this is about solar returns, and this is the last question that's coming up. Do you have any comments, Mehdi, about solar returns? We've got it in the balloon chart on the penultimate slide about the 0.9 million of income. What's the capex and what the returns on that?
Yeah, sure. So solar is very important on a number of aspects. First of all, it future-proofs the portfolio. It improves our ESG credentials. But it's also good from a returns point of view. And I'd say the range of returns depends on a scheme-by-scheme basis. And more specifically, it really depends on how much the tenant within the building is able to consume from the energy we create versus how much we sell to the grid. And clearly, the more we can sell to the tenants, the better from a financial return perspective, because the pricing there is better. And to give you a range in terms of IRR, it would range from the middle single digits, so 5-6% for the really low one, to mid-teens, 15, 16, 17% for the better schemes where the tenant is actually absorbing a lot of the energy we produce.
Okay, thank you. Very clear. With no further questions, I'll look to hand over to Phil just to close off today's presentation.
Well, just to say thank you very much for everyone to join, and just a reminder of those key messages. High quality portfolio remains well positioned, solid operational performance, progress on the strategic priorities, and good visibility on driving performance. But I do want to make this point again. I mean, to the comment that came up. Despite this progress, the board and the manager are acutely aware that the share price continues to trade at a significant discount, and there is complete alignment and a clear focus on delivering value to all our shareholders in an effective and efficient manner. Thank you very much for joining.
Perfect. Phil, Mehdi, Charles, thank you for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of TRITAX EUROBOX PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.